Good morning, everyone. On behalf of Vetiva Capital and our media partners at Frontier Africa Reports, we welcome you to another edition of the Vetiva Breakfast Meeting. In today's session, our economists will be updating us on the recently concluded Mpc meeting. We'll also be getting the usual rundown of the fixed income and equities market, and then conclude with headlines from across Africa by our media partners at Frontier Africa Reports. Once again, I'd like to remind everyone that the meeting is being recorded and it may be shared with third parties. It is also being streamed live on our Vetiva online Facebook page if you prefer to view from that platform. The session is set to last for 30 minutes inclusive of Q&A. And if you have any questions during the course of the session, you can send them in using the chat function available on Zoom and the comment section on Facebook. However, we'll be having a Q&A segment, and if you'd prefer to speak, you can use the raise hand function and you'll be allowed to speak. We will now be starting off with Ibukun Omoyeni, our economist, and he'll be giving us updates on the Mpc meeting. Good morning, Ibukun.
Good morning, Victoria, and good morning to everyone. So yesterday we had the fourth Mpc meeting for the year, and just as expected, the meeting ended on the same notes as all benchmark interest rates were left unchanged. But what was really critical about yesterday's meeting was the new CBN's FX policy, which is the discontinuation of FX sales to real exchange operators, as well as the bank will no longer be licensing real exchange operators, and that's actually due to the continued weakness of the Naira in the parallel market. So what we discovered is that according to the CBN's estimates, the fundamental value of the Naira is around 430 to 440 Naira to the dollar, but the Naira has continued to hover around 500 Naira to the dollar. So according to the CBN, due to the premiums being enjoyed by these BDCs, it is affecting the price stability objective of the CBN, which is actually stoking inflation. Just as we all know, inflation has been moderating. It moderated from April down to about June. But what we've discovered is that imported food inflation, which is the closest proxy to FX-related inflation, is still on the rise. So the CBN is trying to curtail inflation using the FX tool. However, when you look at recovery, when we look at growth, on the side of growth, the CBN noted that there is recovery in the PMI, as well as the continued expectation of growth for a better part of the year. So according to the CBN's estimates, the economy is expected to grow by 3.15%, which is largely in line with our in-house expectation of 3.13%, driven majorly by base effect, as well as monetary and fiscal support. So going forward, we actually expect the CBN to remain accommodative for the remaining part of the year due to the moderation in inflation and continued expansion in output growth, which will be supported by the easing of OPEC production cuts, as well as the removal of restrictions on the ICT sector. So that sums it up for the Mpc meeting. Thank you.
Thank you very much, Ibukun, for the update. Next up is Simbiat, and she'll be reviewing the equities market. Good morning, Simbiat.
Good morning, Victoria. Good morning, everyone. Like she mentioned, I'll be reviewing some of the equities market across West Africa, and I'll be starting off in BRVM. The index consolidated on previous day's gain to close 36 basis points higher, improving year-to-date return to 15.33%. As expected, we are beginning to see sell-offs in stocks that have seen significant price appreciation in previous sessions. The likes of Sicor Côte d'Ivoire saw a price depreciation of 7.01% yesterday after having 7 sessions of gains in the market. Investors also took profits in Shaft Afrique Motors and Crown Cement, with ETI recording the highest volume of trade. For today, we expect to see mixed activity level. However, we still expect profit taking to continue in some names and positive patronage across familiar names like Sonatel, Crown, and ETI. And over in Ghana, the market recovered from the flat close we saw on Monday, as the index gained 2.33%. This was largely on the back of the three gainers we saw in yesterday's session. Guinness Ghana Brewery gained 6.38%, followed by MTN Ghana, recording a price appreciation of 4.17, and it was also the most traded stock yesterday. Last we had Fan Milk that gained 2.19%. The year-to-date gain in the market stands at 39.71%. For today, we expect to see market trading in similar pattern, with market breadth remaining positive. For any of our listeners looking at exposure to any of these markets, they can reach out to us via email at dealing@vetiva.com or to our sales team at sales@vetiva.com, and we'll get back to them. Finally, in the Nigerian markets, the equities market saw a reversal of previous days' gain as the index declined 12 basis points. This was on the back of losses across sectors. We saw counters like Wema Bank, MTN, Unilever, UACN all shedding points. Market activity also saw a further decline, with volume and turnover trading down by 1.39% and 15% respectively. Speaking to sectoral performance, with just 2 trading sessions into the week, the oil and gas index has gained 4.28%, well ahead of the other sectoral indices. Topping the gainers chart yesterday was Orlando. The stock has had about four consecutive sessions of significant price appreciation, meaning investors are showing a sustained interest in the stock. Orlando was up 9.86% yesterday to close at a new year high of 4 naira 79 kobo. Going into today, we expect to see improvements in market activity as investors await earnings release from some of the large cap names. Some companies released their half-year results yesterday. We saw Vitafoam and Ikeja Hotel half-year results. Vitafoam improved half-year revenue by 62%, while profit after tax also grew by 59%. The stock has seen increase in buy-side activity in recent sessions, and we'll see how the market reacts to these results today. Then for Ikeja Hotel, the half-year results showed a 29% growth. However, it wasn't enough to pull the company from loss-making, as it posted a half-year loss of 229 million. We'll also see how the market reacts to this news today. Thank you very much, and that'll be all from my end.
Thank you very much, Simbiat. We'll now move to Omorege, and he'll be taking fixed income and currencies. Good morning, Omorege.
Good morning, Victoria. Good morning, everybody. Supported by the OMO repayment of about 16 billion that came into the system yesterday, liquidity improved slightly to open at 9 billion positive, coming from the 18 billion negative that was recorded on Monday. Consequently, interbank rate tightened by over 63 basis points as OBB and overnight closed at 15.75% and 16.25% respectively. We expect interbank rate to trade at similar levels today, barring any significant change to system liquidity. The parallel market lost 1 naira yesterday to trade at 505 naira to $1, while the new window trader opened at 411.42 naira to $1. The highest rate that was recorded yesterday was 412.95 naira to $1, while the closing rate was 411.67 naira to $1. We expect the naira to continue to depreciate in coming days following the CBN's ban of sale of FS to the BDCs. Brent and WTI gained about 0.5% and 0.6% respectively to open today at $74.86 and $72.08 per barrel, as data released showed that the US crude inventories fell more sharply than what was expected last week, which reinforced the expectation that demand will outstrip supply growth, even in the midst of surging COVID-19 cases. For the T-bills market, it traded on a muted note yesterday with bullish sentiment observed across the benchmark curve. We witnessed interest on the CBN special NTB, that was the 30th August 2021 paper. Trades were majorly consummated on the short to mid end of the benchmark curve, especially on the special NTB 28 October 2021 and the 25 November 2021 maturities. Overall, average benchmark rate declined by about 39 basis points to close at 6.06%. For the OMO market, it also continued on a quiet note yesterday, with slightly mixed sentiment seen across the curve. Trades were majorly executed on the short and long tenor papers, particularly on the 28th September 2021 and the 15 March 2022 maturities, with average benchmark rate declining by about 1 basis point to close out 8.32% at the close of yesterday's trading session. There's an NTB auction today where the DMO is offering about 216 billion across the three usual tenors. That's in 91, 182, and 364 days. We expect marginal rate to maintain on the 91 and 182 day papers at 2.5% and 3.5% respectively. For the 364 days, for a 364-day paper, we expect marginal rate to moderate, given that secondary market is currently trading at around 8.1% levels, and also coupled with the fact that the last auction, it was largely oversubscribed, and the DMO just feed about 26% of the total demand that was seen in that auction. So we expect this particular auction to be largely oversubscribed. However, given the significant amount on offer on the one-year paper, which is about 161 billion, we expect that this might taper the moderation that we are expecting if the DMO decides to take everything that they have on offer or even oversell the offer amount. Our expectation for the marginal rate on the 364 days, we expect it to close between 8.2 to 8.5% from the 8.67% it closed at the last auction. For the bond market, it continued to trade on a quiet note yesterday as market players decided to stay on the sidelines in anticipation of the outcome of the Mpc meeting. We observed sell-side interest towards the close of yesterday's trading session, with an average of 10 basis point increase across the mostly traded maturities yesterday, which were majorly on the long end of the benchmark curve. It's interesting to note that the 2050 maturity traded at above 13.25% levels, given that it closed at 13.25% levels at the last auction. It was previously trading at 8.2, 8.15, 13.2% and 13.15% levels prior to yesterday's trading session. So most of the trades that were consummated yesterday were on the short to mid end of the benchmark curve, particularly on the 2023, 2035, and the 2036 maturity, with average benchmark rate remaining unchanged at 12.53% at the close of yesterday's trading session. For the Eurobond market, it traded on a very active note as buy-side interest we are seeing across the sovereigns. The most actively traded sovereigns yesterday were the Nigeria 2022, Nigeria 2023, the Nigeria 2025, and the Nigeria 2049, with average rate declining by about 3.5 basis points. In the corporate space, we also witnessed buy-side interest, particularly on the EcoBank 2024, EcoBank 2031 Eurobond, as well as the Seplat 2026 Eurobond. For our expectation today, we expect the bonds market to trade actively, with current sentiment most likely to persist following CBN's monetary policy committee decision to hold all parameters constant. In the T-bills market, we expect the market to trade on a very muted note today as market participants focus on the NTB auction that's happening today. That will be all for fixed income. Thank you very much.
Thank you very much, Omorige. Next up is Faith from Frontier Africa Reports, and she'll be giving us headlines from across Africa. Good morning, Faith.
Hello, good morning, everyone. From Frontier Africa reports, I'll be going first with Ghana, West Africa, where Gridco has named Mark Barr as the new Chief Executive Officer. From Ghana, we'll move on to East Africa, where the United Kingdom has signed 132 million British pounds sterling new investment deals with Kenya. That's actually a good one, and it's already posting signs of having this move better the economy of that country. The International Monetary Fund has warned that there is a risk inflation that will prove to be more than just transitory. Of course, this is making the International Monetary Fund ask that central banks should push to take preemptive actions. And the IMF is also holding the 6% 2021 projection and the 4.9% projection for 2022. Yeah, with that, we'll move on to Southern Africa, where the Zimbabwean inflation has slowed to double digits in July for the first time in more than 2 years. Of course, we are hoping that that will be sustained. The consumer prices rose 56.37% from a year earlier compared to the 106.6% in June. The Zimbabwe's National Statistics Agency showed this yesterday in an emailed statement. They're also eyeing 25% inflation figure. That's, they are hoping that it will go down from the 56.37% that was recorded in June. That's it in Zimbabwe. Also, the recent unrest in South Africa is still ongoing. The unrest is still, it appears to be growing thicker, and it's likely to show about 0.7% of the headline gross domestic product growth of South Africa in the year 2021. But also there is hope that strong commodity prices will continue to support the nation's economy. This projection is coming from S&P Global Ratings. From South Africa, they will move on. And of course, that's where we'll be drawing the curtain from Frontier Africa to North Africa, where the Contact Financial Holdings has announced successful closure of its second Sukuk insurance of 2.5 billion Egyptian pounds by its subsidiary, Sarwa Sukuk Company. In Tunisia, the National Agric Bank, the NBI, has recorded 2.7% to 375 million dinars. And that's also a good one there from Tunisia. That will be all from Frontier Africa reports. Thank you.
Thank you very much, Faith. We have now come to the Q&A segment. If you have any questions, you can make use of the chat function available on Zoom and the comment section on Facebook. And if you'd prefer to speak, you can make use of the raise hand function and you'd be allowed to speak. But it looks like we already have some questions. The first question reads, please, what is the outlook for the Naira to dollar rate now under the new CBN regulation? I'll direct that question to Dapo.
Okay, thank you, Victoria, and thank you for the question. So I'll go from the fundamental economics. It looks more like you're choking out the supply source, even though the CBN governor had noted that this will now be pushed to the banks. But again, it takes a bit of time to get structures in place and, perfect how the full operational dynamics will flow. And we're also quite aware that a couple of banks don't even, like the retail side of FX pretty much. So some bottlenecks might still come up, and it goes back to the final ultimate user who would find the challenges. Let's also remember that it's not that the parallel market is being scrapped. It's just that CBN has said, I am not selling the $20,000 every other day that I typically sell to you, because you buy cheap and you then round trip and sell so expensive. So in terms of outlook, Thinned out supply, definitely, fundamentally expect that rates will start to spike. As I yesterday evening and into this morning, the market isn't quite clear yet. The stories you keep hearing is I don't have for now. So we hope things start to settle, but one thing is certain, we start to see rates jump up until CBN finds a clear way to stem that tide. Now, this is not the first time this is happening. It happened in 2016. And at the time when the CBN announced the stop of sales to BDCs, Naira dollar was trading about 268, but by the end of that year, we had moved to about 465. And if I remember correctly, that was the year that, or the following year that we moved to about 505 before CBN started selling back to BDCs and also jacked up OMO rates to attract investments, because the fundamental problem still remains dollar supply. So we don't know how this will pan out fully or where we would get to, but we know one thing is for certain, that there will be some moves in the currency which might be strong, depending on how banks are able to meet demand or perform the duties that the BDC were doing previously. But we all know for paperwork and all that, people would rather again deal with parallel market people. So again, on the base of that, we see the Naira worsening and towards the year end before something strong happens that creates strong supply. On the second question, yes, clearly, let's remember that there are still about 44 items that are still banned from the official window. And these items are things that Nigerians are still using constantly. Let's also remember that we're largely an import-dependent economy. And over time, because of the waiting period, people would rather just, deal at the parallel or the BDC segment of the market, the unofficial window, to get their things done and get things moving fast. Now, if you're saying to a large extent, some sort of supply to that segment is being taken off to and, taken to the bank desks, it creates additional bottleneck, make things more expensive in that space. For those who can still find to fulfill their obligations, it will definitely mean that they'll find a way to transfer the prices to consumers. And knowing where we are currently, this is an imminent uptick in inflation. There's an imminent uptick in inflation that could be expected as well. So that's our view: inflation, worsening economic conditions, until or except there's a strong factor that CBN knows or has found to make the impact of this less felt. But other than that, we see inflation ticking up. We see dollar Naira rates also ticking up. I noticed there's another second part to the first question. Like I mentioned, we're trying to see how the market will settle into today, tomorrow, to know the dynamics of even converting Naira to dollars and the rates, basically following yesterday's pronouncement. And then we can give guidance as to how you can buy Euro bonds or dollar-based bonds, basically. I believe that answers those questions.
Thank you very much, Dapo. If you have any more questions, you can send them in using the chat and Q&A box. Okay, looks like we do not have any more questions. We have now come to the end of today's session. On behalf of Vetiva Capital and our media partners at Frontier Africa Reports, we'd like to thank you for joining us today, and we hope that you have a productive day ahead. Thank you and good morning.